begin with, this is our third gathering. Actually, like we started in the month of April. So every month we do one event in DevX where we invite different founders who are featured in Shark Tank, who featured in other national, international platforms. We'll call angel investors. So our main motto is to get more student startups onboarded in our community to help them with agreements, IPR, startup related documentation, everything, and also the investor support. We are going to organize a startup hackathon where we will be calling all the startups who have pitched here in our events. To be more specific, this Lay Startups Confluence is a platform for exploring startup trends, technologies, transformations with founders as well as with investors. So we extend our sincere gratitude to our sponsors like a strategic legal partner, Mintage Legal, a resolution partner, Dispute Resolution Hub, our financial intelligence partner, Spondylix, our community partner, Golden Women Club, and our knowledge partner, Nyan Nauka, like for their invaluable support in making this event a reality. Let us begin the event, our third event in DevX.
Focus on capital raising. And just want to understand from your vintage point of view, what are the most common misconceptions startups have about funding, fundraising, and other stuff?
Thanks for having me here. I'm Amit Mangal. I recently started my advisory service in investment banking, Opulix advisory. I'm a chartered accountant by profession. I have 23 years of experience, industry experience, and so far I worked as CFO and leadership position at various companies. So to answer your question about the misconception that people have is that funding is the first foremost thing without which business cannot happen. I don't believe in that. What I believe more in is the execution capabilities. The most important thing any startup or anybody should have is about the execution capability. Even the good ideas don't succeed. It's not because of funding, it is because of the execution skills. I've seen many startups who get good amount of funding. They get whatever they ask for. But when it comes to execution, they fail. They start doing something which is like for high growth, they start building on giving marketing freebies. They start growing into many cities across India because they want to show high growth. But it is more essential is that the execution capability our startup has. What I mean by execution is that the product that they have, whether it is service or it is a real product, it needs to get that firm thing in their mind that this product is that works. People are recognizing that this is something giving them benefit or they want to use it. And also, if it is a manufacturing thing or something else, that in the current city or in the current way that we are developing, it has developed and now they can go to the another cities to grow. So, as I said, to answer your question again, is that it's just not about funding, it is more about execution skills that any startup should have. So, take out the misconception that funding is the only thing that will take the startup to the next level.
Just want to understand. You have top talent recruitment that intrinsically when it is focused with the company. Okay. So what do you think should be at the most concentrated level and where people go wrong?
A talent acquisition.
Talent acquisition in top areas to startup. Because co-founder chooses co-founder and everything founder goes.
Okay. Thank you, Akash, and thank you, and everyone for having me here. This is my second time coming to the Startup Confluence. I've been very happy here. Answering to the question of what you have is, I have spent about 27 years in the technology industry. So I breathe, I live, I drink, I sleep, I eat technology. The most toughest thing for the startups today is to attract the talent because there is no branding. They don't have branding. For example, I could see around 50 startups which are about to become unicorns. So, getting the right talent at the right time in the required space. And the second thing is staying with the company for a long period of time, being with the company for commitment. 90% of the startups fail because people leave at the back end. When they're about to become successful in the next few months, they leave either because of social pressure, family pressure, financial problems. They leave. So my urge, my request and appeal to you is please don't leave the startup when you've already done. Make it to a point that you take it to the next level. You create job, you create more opportunities for the people. Okay, don't go after jobs. I'm very happy to see all of you here that you wanted to become, you are entrepreneurs already. So there are 3, 4 things that I wanted to tell you. Before becoming a unicorn, you should become a sunicorn. Before becoming a sunicorn, you should become a minicorn. So most of you are minicorns, which is about a 1 million. It's defined as 1 million. Anything which is 1 million is called a minicorn. Anything up to 50 million is called a unicorn. So most of the companies that we are seeing about 50, 80, 100 people are all, unicorns. And then next step is unicorn, where you get 1 million valuation. So I think these are the 4, 5 critical things, to tell you and to attract and also to retain the talent. Today I tell you, attracting talent is one, but retaining the talent is even more critical to be in the whichever industry we are from.
Beyond the initial capital, what crucial due diligence aspects are there for creative funders? And how does a startup prioritize on this due diligence? Because generally, when they go for a funding, valuation wise, they will be successful. But when it goes to due diligence, somewhere things don't say well.
Correct.
What do you think they should do?
See, due diligence is the most important aspect. Being the finance person myself, and I've got due diligence done in a lot of organizations from in the companies that I've worked with, and also when they look at M&A from an acquisition perspective. So due diligence is like looking at how the startup is working. It's just not in the finance aspect, but also legal aspect, how the legal is managed, IT aspect, how the IT is managed, how the legal aspects are managed, and many more things. So they need to pass that test for the company to invest in that company. So due diligence plays a very important role. And also, I always tell all the startups is that they should prepare themselves like a company who will come with an IPO in say 5 year time. So when I say IPO, it means that they need to be ready with all the aspects. So many of you must be knowing that for IPO to come in, the company need to file DRHP, draft crediting prospectus with SEBI for approval. Then they can go to the market and raise funds, public funds. But DRHP is a process. The preparation of it starts not just like 1 year before; it starts many years before. So they need to be pretty sure that they have robust processes, robust policies, so that they have everything clear whenever whoever comes in, whether it is an investor, whether it's a SEBI, or whether it is anyone else. So need to be ready. Always be clear about corporate governance issues, ethics, transparency, because this is something that just stops from any organization to grow.
With your focus on operations and managing things. Well, there is a venture act done for when there's a VC interested in the fund. We see people in their expansion program start opening branches.
Correct.
What's your take on it? What should be the best way to handle such type of enthusiasm, which is best backfire?
Talking about VCs, here the most important thing is VCs, even before they go and acquire or do any kind of funding, it is important that these people do their what do you call what kind of an exit that they are giving to the investor. That is the most critical. You need to understand this. You take an X amount from say Amit or me or Moksha sir. When can you give the exit? 3 years, 4 years, next. What is the return that I expect from the exit? So that should look lucrative, attractive. Your due diligence is very important for 2 things. Due diligence report has a checklist. You can actually Google and see it. 1, 2, 3, 4, 5, all the due diligence 20 points will be there. What are the documents and what are the things that you need to put in the due diligence report before you get a funding? Point number one. And tomorrow, when any company wants to acquire your company, when they give a verbal agreement saying that we are acquiring for 10 CR, 20 CR, also they do a proper due diligence process. What is your top line? What is your bottom line? What is the revenue you are going to get? What is the profit after tax? So financial checklist is very critical and important. You need to make sure that your compliance is done, your legality is done, all the 24-page document you're signing, but get it vetted. People like Moksha, they have a fantastic agency where they do day in and day out. They go through all these things. They will handhold you and tell you where to do, what not to do. So having a professional legal firm on your right hand is definitely a big, big plus point for you. Ensure that all the legalities, all the compliances, all the GSTs, all the things are being done, because you never know. You never know when any company may like something and they wanted to do a funding or an acquisition tomorrow. So have the big picture in mind. Have the big picture, and definitely I'm sure you can take it, to the next level.
With reference to the general struggle of a PC family, after that there is a strategy shift. So what should be the focused strategy shift to see that the vision which VC has seen in the startup founders is sustained, and they see that the VC fund doesn't get diluted as their shareholder? What do you think should be the key strategy shift is there to do? Because struggle to get a VC fund is you show the numbers, you do all that stuff. But the moment VC funding comes, what should they do and what should VC care for?
So basically, like I gave an example of the company I work with. First of all, the founders and the investor both need to develop what kind of matrices they are looking at on a regular basis. So there in that company, we developed a set of matrices that shows the progress of the company. In the month of April, we are showing that these are the matrices. Then in the month of July, we again show like how we fare as compared to those matrices. Then we prepared a product plan. So the product that we have now, what are the features upgrade that we want to do? What is we are looking at as a GTM strategy, go to market strategy. So how the success rates are. Then the second product, third product, the product plan. So before getting the VC funding, when you are 100% own funded, you can do the things the way you want. But once a VC comes in, you need to be systematized, you need to be professional in your approach. You need to make sure that you transparently showing what it is. So that is from the company perspective. When it comes to a VC perspective, then again they look at those numbers, feeling that the company is trustworthy and giving the data the way they should. And also they tell the company that okay, we know a lot of investor, we know a lot of people who basically can help you grow your business. We know a lot of people who has the connect in the industry. So like that was a Mintage startup. So in the US, who are the people who can help you increase your product reach, increase your marketing, and increase your uh, investment at the next round. So a lot of things. I mean, both can work together and do it.
I think I can add to what Amit has said rightly. When you actually take a VC funding, what happens is the VC company will also have one or two people on your board. Okay, this is to see that you are going in the right direction. There's nothing to worry, because actually they're hand holding you. End of the day, guys, realize one thing: what are startups you're doing, when you reach 10x, 20x valuation, it is VC also is going to get benefited, right? So we hand hold you actually.
Only question: money comes in, money also goes out.
Okay.
I just want to understand how do we manage the compensations paid vis-a-vis operational efficiency?
Okay. Very good question. I think very good, very valid. I know. See, one thing is money comes in, money goes out. That's why in Telugu it's called Dravyam. Dravyam means which has a dignity, which is a flowing nature. So actually, there is an this thing saying that whatever you give with your right hand should not go to left hand. Correct. Anyway, what is the compensation structure that you are going to create in the organization to ensure that there is a internal parity is being met? Whatever X compensation that you take a talent into your company should be rightly compensated. Never capitalize and take the advantage of their situation. That most of the startups do the mistake. He's anyway needs job now. He's jobless last 2 years. Okay, so let me hire him for this thing. Don't do that. At least take him as an intern in your organization. Pay some 10,000 rupees to him because he also has his own expenses. End of the day, he should not feel that he's being manipulated. He's being used, misused, or even abused. Don't use that. Take him, pay him. Let him see because he may be the person tomorrow, he may give you a very big project. Today, I am in touch with the people who almost 18 years who gave me a job. I worked with them for about 2 years. I am still in contact with them. Relationship management is critical. Whether you're doing your funding, whether you're scaling up, whether you're hiring people, never take him as an employee. Think that you're taking a part of family. Make him feel that you are providing some security and safety net for him the moment he comes into your company. Because today, in the world of social media, people go out and can write and talk anything about anywhere, any company. There are 2, 3 bad negative reviews can actually mar your company or mar your startup. So make sure that you're compensating people whom you're hiring rightly. Rightly. Don't what do you call take advantage or exploit them. Exploit their skills. Don't exploit the person because he also feel with good matters.
There's a perceived risk in always raising money, be it in the form of a red finance or in the form of an equity investment. So for a startup, where do they actually balance it? Where do they actually say that okay, this is the point where I can manage the red finance, or no, I can go back to my VC and then have a talk. What do you think should be the
So, first of all, I want to ask if anyone can answer is what is better, debt or equity?
They can't. They don't know.
Anyone can answer, like, if for your startup or anything you're trying to do, whether you would like to raise equity or debt, which one is better, debt or equity for funding?
It depends on your business, I think. If you are making a profitable, then I prefer to give a take a debt. And in case if you are burning or if your burn rate is increasing, then I think you should go with equity.
Okay.
But as per your projection plans, I could be wrong.
Anyone else would like to answer?
First, it's better to go with that.
Debt. Okay.
If the person who was investing has the larger market related to your product, then you can go for equity because the solutions and their like they will be the main person in the industry means it will be helpful for your marketing and strategy.
Understood. So what do you see? I'm asking. I mean, he asked me. Like, I'm asking you. So what are the risks that you see with debt funding? There is always the certain kind of leverage the company can have. So there are risks, of course, associated with debt. So what are those risks? If anyone can talk about.
They may be asking the shares or something else that can be a problem to the company.
No. First, all of you understand the difference between debt on this thing and also on equity. What is the difference? Do you know that? I mean, fundamental difference. Yeah. You
You
need
say that you are actually committing interest.
correct.
And this interest is a commitment which is monthly, quarterly, or yearly, but ideally it's going to be monthly unless there is an agreement which says you pay quarterly. I've hardly seen such agreements. Now, an equity, on the other hand, waits for you to make profits and gets dividend whenever you declare. Now, this is what the definitions are. Now, you have many styles of debt. Debt funding is again emotion. You have working capital term. If you go to a bank, they will say it is one of this property, or it's a term loan, or a sector finance. So many things are there. Ultimately, it is a commitment of interest,
Correct.
which hits your bank without your consent every month, since you have given consent before. Now, equity is it's a leverage. You don't pay anything. When you make profits and you feel it can be distributed, then you can declare a dividend. That's the difference. Now, with this, you can.
Now you got the difference, right? You understood the difference. I think in the interest of everyone, I think Moksha sir has given the clarity. what is equity and what is debt. Now knowing the definition, what do you think you prefer, this or that?
To get debt is very easy instead of equity. Because something on easy. Any asset you can get a debt, but any asset someone is not just to invest on our company, not a asset.
So like the companies, especially the MSMEs, like those small medium companies, because for them it gets difficult to get funding from banks. So they always try to do self-funding. And also whenever they try to take loan, they go to bank and pledge their assets, so the property or anything they have to take loan to run the business. Here you need not dilute your equity. The valuation of your company can grow, and if you dilute the equity, then you don't get the benefit. So from a cost perspective, you always said that equity is costlier than debt, because in the long term, if you dilute equity now to grow your company, then later on you don't get the valuation for the dilution. So the risk, to answer this question, the risk that is associated with that is that you are not able to run your business, you are not able to generate cash flows to service the debt, and because of that becomes NPA, non-performing asset, and because of which the bank can take you to NCLT, bankruptcy code, and also that will result maybe in sale of your business or the closure of your business. So always the people who are taking back need to make sure that they have clear plan as to how to service that debt, how to pay the interest, installments, EMIs on a regular basis.
Correct.
If they don't do it, they will be in suit.
Sure.
But when it comes to equity, as I said, the risk associated with it, the people think that it is a permanent capital, they did not return it back to the investors. Let's take equity, why go for that?
Correct.
But a sound businessman, the people who understand finances will say that I will take the right amount of debt, grow the business with that, increase my valuation, and then take dilution on a higher valuation.
Yes, exactly. Exactly. I fully support Amit. I think even I would go for equity. Why I would go for equity? I'll tell you. If I have to scale up the business, for example, from X amount to 100X, okay, why should you take a debt and do it? Here, the major advantage is you are not giving anything. You're only putting your signing and paper, and once that happens, you are benefited, they are benefited. So I request all of you, did you look at the term sheet? There's something called a term sheet. You can, now it's Google, I think Chat GPT, everything is there. You can ask, what is a term sheet? Please go through it. Even people who do not want to go for funding right across, maybe 6 months down the line, you got to know what are 1, 2, 3, 4, 5, 6 points which are listed in the term sheet, which will give you more clarity in terms of how to do go for funding, what are the things which are required. If you are not happy with A, B, C clause, 7th B, 9th D clause, you can always tell them this. Then go to your advocate or attorney or lawyer and say that, sir, can you modify this in my favor? Got it? So please do that.
That was a great discussion. Thanks, Amit.
Thank you. I just want to wrap up with 2-3 minutes. This is my second time here. I think the reason why I wanted to suggest or say something to you is that I love being a startup because I myself am a successful startup long back, about 20 years back. One thing is, first have your idea very, very, very clear. What is the ideation stage? People, I've seen someone saying that, sir, we wanted to start something. Sir, we are about to start. Do it. Okay. Second, make sure that who are your founders. If you want to pick up one or two. Third, try and understand the most important question wherever you go is what problem you're solving. Write it down. Ideation stage, then what problem you're solving in the market. Okay. What is the solution that you're going to do? Who are your competitors in this field? Okay. Then what are your target segments? Who is your target audience and target segments that you're going to talk? Whom you're going to address? Are they available here or overseas? Okay. And what is your investor pitch? What you're supposed to do for your investment? How much actually money in here? And one more thing, if you need, for example, a bootstrapping of 10 lakhs, don't go for 10 lakhs. go for 20 lakhs. Because discussions will percolate and finally you'll end up getting less. Always ask for double and make that VC, feel that you are the best and they wanted to invest. Make sure that you're giving a good exit, clean exit to the people who are funding. Okay? Try and tap as many doors as possible. Because there are many people who give loans without collaterals. Nobody talked about collateral today. I want to talk about collateral. Because when you go to any bank, everybody, they want what is your collateral. This is only our collateral, right? Our intellectual property is our collateral. So without that, there are people who are giving, who trust in your idea. Make a good pitch of investment. When you make all these things, the elevator pitch is only for 2 minutes. So, for example, we have gone to Shark Tank, they'll give only 2 to 3 minutes for you to do elevator pitch. So, how effectively you're going to sell yourself and your products and services so that they get tempted and attracted and to invest in your company. So, always look for long term. And last thing I want to do is learn, unlearn, and relearn. Keep on updating yourself and never give up till the last minute. I've seen many startups, not one, more than 300, 400 startups I've seen. They leave on the verge of success. Don't leave it. Make sure that you go 1 year, 2 years, 3 years, burn and put your skin into the game. Don't take it's already. Don't think that I cannot do it. Make sure that you'll become successful. Have that determination with you. I'm sure you'll be successful. Thank you so much.